Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Tuesday, October 28th, 2025. Welcome to the show. I'm your host, Dave Keller, coming to you from a kind of classic rainy fall day here in Redmond, Washington. Hope you guys are all doing well, hanging in there wherever you're at. The S&P 500 getting dangerously close to the 7,000 level. Why is that an important level? Number of astute viewers have reminded me this week. I did promise that if and when the S&P closes above 7,000 for the first time, I'll play my trumpet on the show. I don't play that often, so this is asking a lot. But I think recognizing the severe strength of the S&P, recognizing that move above the crazy 7K level is worthy of no less. So I've got the instrument out. We got it oiled up here. We'll get it ready to go. It almost looked like we are going to do it going into the close here. The S&P did get up to 69.10, but last half hour, kind of a distribution day for the last 5 trading days, by the way. Actually, 3 of the last 5. I'll have to check that 5th one. 3 or 4 of the last 5, certainly 3 of the last 4 have had a steep sell-off into the afternoon. It has not stopped the market from going lower. Yesterday, of course, we accelerated to the upside going into the close. Today, very similar to Friday and Thursday of last week, where we actually sold off in the last half hour of trading. Is that a sign of distribution? Well, conventional wisdom would tell you that is big institutions unwinding positions going into the close. Lightening up going into the end of the month, selling on strength. Is that changing the overall trend? Is that stopping this relentless trend from going onward and ever upward? For today, it is not. Let's look at the charts together. Our show has 3 general point parts. We will look at the performance of the markets today using what's called the market dashboard here on stock charts. We'll look at a heat map focusing on individual stocks, themes, groups, sector plays within the day. And then we'll look at some individual stocks, which I have hand selected to help us make sense of these markets. Looking at the starting with the market overview here, we're looking at the S&P 500 up 0.25%, 68.90, just below 68.91. As I mentioned earlier, we did get up to around 69.10 during the trading day. Last half hour, kind of weak. That's been a pattern here. Now, those days that I mentioned have been pretty good up days, and then just distribution going into the close. That implies institutions selling in the last half hour. That's when they're unloading some larger positions, maybe taking profits after the run that we've experienced. Again, that would generally, to me, be a sign of not optimism. However, keep making higher highs and higher lows. I'm going to keep following this trend. The NASDAQ continues to be the strength, the juice in this market. The NASDAQ 100 up 0.8%. You're going to see in a moment technology kind of crushing everything, and it's actually even more exaggerated than you might think. I'll show you a chart about that in a little while. Mid caps and small caps both down today, right? Mid cap S&P 400, the worst performer, down almost a full percent to the downside. So the NASDAQ up about 0.8%. The mid cap S&P 400 down 0.9%, just the latest, chapter in this book off of the April lows, which is large over small, growth over value, and mid caps and small caps just still not getting the love. Lower interest rates arguably should be a great tailwind the smaller you get, right? Because big established companies aren't borrowing a ton of money. So low interest rates certainly don't tend to help them. Lower interest rates tend to be great for small cap stocks because they're the ones that are in the borrowing phase of their growth trajectory. Not seeing it yet, though. Rates are generally coming down. Small caps still underperforming. The VIX actually a little bit higher today, right? About 0.6 to the upside in terms of VIX points, still in the 16 handle. Yesterday, we actually closed below 16, so slightly higher today. But still in a fairly low volatility environment as the VIX generally around 16, pretty low vol here. All right, looking at the bond markets, we can see the TLT was up about 0.25%. 10-year and 30-year points generally drifted lower today. The 5-year point was relatively stable. The dollar, not much of a change from yesterday's close as well. We have the Fed meeting today and tomorrow. The October Fed meeting. We have one more Fed meeting in 2025 in December. This one, no surprises expected in terms of a 25 basis point cut. That's essentially priced into this market here. The question is going to be digging into the language of the official release in the press conference, pressing Chair Powell on expectations for rate cuts going into next year, certainly in Q1 of next year. It's where things get a little less predictable and a little less consistent in terms of everyone's expectations there. But for now, bonds slightly higher, rates generally coming down. Gold continued to come off, actually opened quite weak today. The GLD got down to almost 360. It did close toward the highs of the day around 364. That was nice to see, but the GLD definitely below the 21-day EMA. That's a problem for me. That's where I start to lighten up and start to at least take some of that off, because the break of the 21-day EMA always comes before much more significant breaks. And while I can't guarantee we're going to plow through the 50-day moving average and get all the way to the 200-day or something like that, I know we've broken that initial level where I start to, just for defensive purposes, just for maintaining the capital, start to take some off. So I'm unwinding a bit of the GLD. We get back above the 21-day EMA. I think that'll be a really good sign. We'll look at the chart. I think I grabbed that chart. I forget which charts I grabbed here as we're going live. Energy all getting crushed today. The USO, natural gas, all moving lower. Cryptocurrencies accelerating to the downside just in the last couple hours here. We can see Bitcoin was up around 116,000, but during the equity session, it's gone down to just below 113,000. All 10 of the top coins tracked on the stock charts platform in the red today. Looking at the S&P sectors, right? Sector breadth, not great today. The technology sector up about 1%. Everything else was flat to down. Materials and consumer discretionary were number 2 and number 3. They really didn't go up much from yesterday's close, but look what happened on the downside. Real estate, one of the more defensive sectors, down over 2%. Utilities, another one of the more defensive sectors, but also kind of a growthy play on, energy requirements for, all the AI stuff. Down 1 2/3%, so 1.7% down for the XLU. Energy, consumer staples, both down about 1%. There's some earnings happening with some of those names. It's also just general rotation out of defensive positioning, which is what we're seeing. So while the sector breadth was not good, the actual stock breadth even worse. We can see in the S&P 500 4-to-1 ratio of stocks down versus up. So the S&P was up slightly, but 4 out of every S&P 500 names were down today. On the New York Stock Exchange, kind of a broader list, about a 2-to-1 ratio, 62% down, 35% up. So how does this track? How does the market move higher on weaker breadth when most sectors are down and most stocks are down? This goes to the construction of our indexes. If you think the S&P 500 is the market, you're half right and you're half wrong. The half that you're right is it does reflect the prices of 500 or so names, about 505 stocks that are in the S&P 500 right about now. But you're wrong in the fact that it's really only reflecting the price action in a small number of names. 10 stocks make up about 35% of that index. The next 40 stocks make up another third, and the other 450 make up the bottom third. That's how concentrated our U.S. benchmarks are to those growthy kind of Mag 7 FANG types of stocks. So the way that this happens is big cap technology is up, even if everything else or most other things are down. Our benchmarks can still go higher. So I would encourage you. This is a really good time to be looking at equal-weighted indexes to understand what's actually happening with equities. Paying special attention to breadth indicators, super helpful to understand, is it just big cap tech or are other things a part of it? Of course, most importantly, keep watching Chart This with Dave Keller. I'll keep you updated as I reflect on and analyze those movements every trading day. Speaking of stocks actually going up on this day when most sectors are down and most stocks are down, here's why the benchmarks are up, friends. NVIDIA up 5%, closing above $200 a share. Broadcom up 3%. And a sympathy move with NVIDIA and other semiconductors just continuing to accelerate. Microsoft, one of the earnings names this week, up 2%. Tesla up almost 2% as well. Alphabet was the only one of these Mag 7 names actually finishing lower, about 2/3% lower. Note that Meta and Apple were both actually flat for the day, and Netflix finally finding some stability after getting crushed on earnings earlier in the month of October. Nvidia is reporting later this month, in a couple weeks, or later in November. Five of the S&P, five of the Mag 7 names reporting this week. Many of them tomorrow. Tomorrow we've got queued up Microsoft, Alphabet, Meta, all reporting after the close tomorrow. After that, on Thursday, we've got Amazon. So we've got that tomorrow with the three Mag 7 names reporting. We've got the Fed meeting as well. Tomorrow is going to be a busy session in terms of potential market catalysts. All right, let's continue on here looking at the heat map. The heat map is a way that I like to look at the markets from a high level and from a very low level, right? From the macro to micro, the big picture to the small picture. You know, I'll go next, but you go first. What are your impressions as you're looking at this heat map, right? For me, looking at a heat map like this, I'm a huge fan of this type of visualization. Gives you so much granular detail, but also lets you to take a big step back and sort of, you know, understand the general complexion, right? Take an overall assessment of the big picture. And I would encourage you to literally take a step away from your monitor, from your mobile device, wherever you're watching this, literally back away a little bit and just let your eyes blur out a little bit and just think about the overall move today. What I notice, and I hope you've taken a second to reflect on what stands out to you. This does not look like a great day to me. And in the upper left, if you take out NVIDIA and Microsoft and Broadcom, and in the middle, if you take out Amazon and Tesla, it's a really bad day, right? Think about how big of an influence those names have, right? The five biggest names in the technology sector were either up big or flat. The two biggest names within consumer discretionary were up pretty decent amount. And that alone is enough to cause the S&P to finish net positive, even though the rest of the benchmark was basically flat to down quite a bit. And if you look at sectors like consumer discretionary, utilities, energy, real estate, industrials, consumer staples, healthcare, I mean, not a good day, right? I mean, generally pretty negative. Now, what's telling here is it's in some of the defensive sectors like real estate and utilities, consumer staples, arguably the worst looking heat maps here, right? With quite a bit of red on the chart on the heat map. In the financial sector, right? And it's a lot of insurance names, right? Progressive, Chubb. These have not been great charts. They don't look like, the chart of NVIDIA, right? These are not uptrends. These are stocks that have been struggling, that have attempted to break out, like AJ Gallagher at the beginning of October, threatening a new 3-month high, looking like it might pop up on my list pretty soon. And all of a sudden looks like a big bear flag pattern, and we're breaking down below trendline support, accelerating to the downside. It's down another 4% this week. So when people talk about the market looking good, what you have to remember, the market, in terms of what looks good, I would argue it's a fairly narrow part of this market. There are just some big stocks that have an outsized influence on our benchmark. It's big cap tech that looks remarkably strong here. It's the AI trade that looks very good. But the AI trade is working, and at the same time, very many charts are not working particularly well. Now, what would make me feel a lot better about this market between now and year end would be other areas, other sectors outside of technology looking much better and being a lot less red. I would notice, though, that even within the technology sector, you have Zebra Tech down 12% today, making a new 3-month low, or very, very close to it. F5 Networks down 8%. Undercutting previous support. Charts like AppLovin, Cadence, not bad charts. They're just pulling back after testing resistance, not quite following out. VeriSign, an ugly chart, already breaking through to a new 3-month low. So even not all of technology looks awesome right now. But again, the right things look good enough to keep the benchmarks very strong. Do I see any reason to be negative on Microsoft, making a new all-time high this week, breaking above resistance from the end of July? I do not. Do I see any reason to be particularly negative on NVIDIA, up 5% today, closing back above $200 a share? I do not. Do I find reasons to be bearish on a Broadcom, up 3%, making a new all-time high today? I don't. So uptrends are there for a reason. I wrote a note for my market misbehavior newsletter. Just went out earlier this afternoon. Talking about trend following and why. We love to be skeptical of uptrends. I'm not skeptical of uptrends just because they're there. I'm a believer. I'm a trend follower. Friendly reminder: go to my website, marketmisbehavior.com. If you've not signed up for the newsletter, you're missing out on some awesome insights and thoughtful commentary by yours truly every single week. So those are my impressions of the heat map, right? This is a narrow advance. The average stock does not look good here. If you take out some of these big names that are up big today, it's not a great market, at least today. I mean, plenty of these charts to look at. A lot of the financial charts, a lot of the industrials are not that far off of new highs, are still in primary uptrends, making higher highs, higher lows. At worst, they're pulling back right now during an uptrend. But again, I mean, this was a day in particular that if you look at the top line and see the S&P up, probably really excited. I don't know if it's a reason to be excited. It's a reason to be excited about certain stocks that are showing quite a bit of strength. All right, we're going to get to charts here in a moment. I'm going to share a ton of charts. I should have mentioned, as always, your questions are very welcome and much appreciated. Use our YouTube channel, drop a comment with any question that comes up during the course of our broadcast. I so love hearing from you, answering your questions, and we'll do an all mailbag episode on Friday to get through some of the great questions we've been receiving. Do want to give a shout out. Today's episode brought to you by Seeking Alpha. If you go to marketmisbehavior.com/Seeking Alpha, you can learn more about this fantastic site, one that I've used regularly over the years. Particularly, I'm a fan of their quantitative model. Their quant effort, their scanning engine, which allows you to scan on stocks showing strong quantitative criteria. This is a style of investing really called factor investing that is very common in big institutions. Most big money management firms have a huge quantitative team by these days, looking at models, trying to identify stocks showing similar conditions to other stocks that have done quite well afterwards. It's called an alpha model. Seeking Alpha, I would argue, has a pretty good one. I've met with Steve Kress. I've interviewed him for my podcast to learn more about the approach he uses and how he selects stocks as part of their Alpha Picks product. I'm a fan, and so I would encourage you to check out their product. They also have some really cool things about taking your portfolio to the doctor. They call it like a portfolio health check, I want to say. Looking at dividends for your entire portfolio, not just position by position, but helping you think a little more strategically about dividend dates, X dates, and all that sort of thing. Some great, fantastic tools for their premium members. So please check it out at marketmisbehavior.com/Seeking Alpha. If you use my link and or scan the QR code to get there, you get a little better deal than otherwise. And it helps me to make Market Misbehavior awesome. Thanks for checking them out. Before we get to the charts, I did want to just point out, I was wondering what this was going to look like. I had a feel for it, and I thought I would do it. Here are the S&P 500, 11 sectors, and the S&P as well. I am just sorting this table, this performance table on stock charts by 5-day performance over the last 5 days. If it feels like technology is it, and that's the only sector doing well, it's not just you. That is literally what the data would tell you. For the last 5 trading sessions, the technology ETF XLK is up almost 5%. The S&P 500 is up 2.4%, which means over the last 5 days, the technology sector is the only one out of the 11 sectors that has outperformed. 5 other sectors were up, but just not up as much as the S&P. And the next strongest one is the XLY, consumer discretionary, only up 0.8%. So if you own technology in the last week, you've outperformed the S&P by 240 basis points, by 2.4%. If you've owned anything else as a one ETF portfolio, you underperform the S&P. This is how exaggerated that dominance of mega cap technology truly is. And I would encourage you to make sure your portfolio respects that and acknowledges the dominance of the AI trade right about now. All right, let's look at some charts here. Here's the S&P 500, no change to our general assessment. We're in a primary uptrend, and I say that not as an opinion, but as a fact, because the chart is making higher highs and higher lows. I can give you opinions about what I think the market might do, but as a trend follower, I'm much more passionate about defining the trend. I think investors get into trouble not because they don't predict well, not because their crystal ball isn't as shiny or as effective as someone else's. it's because they're thinking about the wrong things. They're thinking too much about what might happen tomorrow and not thinking enough about having an awareness of what's working today. The trend in the S&P is positive, right? We're making higher highs and higher lows. We're above upward sloping moving averages. We're seeing extended moves to the upside. The momentum is improving. The RSI is very close to the overbought condition, first time since the beginning of October. I would say making new highs on stronger RSI readings is a good thing. We are well above the 50-day moving average, currently around 66.12. We are well above my line in the sand, which is the swing lows from August and September. That's around 65.50. I think this is a market in an uptrend until proven otherwise, or as we like to say, innocent until proven guilty. I mentioned that technology dominance on the heat map. We looked at the performance of tech, looked at the performance table for the last week. The breadth today was not good, right? As we mentioned, the S&P, 4 stocks down for every 1 stock that was up. Put another way, 400 out of the 500 S&P stocks were actually down today. That's not a bullish day for the S&P. It's a bullish day for technology. And we can see that reflected in some of these breadth indicators. Here's the percent of stocks above their 50-day moving average. As of yesterday's close, it was around 56%. Today, it's back below 50%. It's at 48%. Can the index go higher on weaker breadth? It can. Are sustained rallies more often driven by expanding breadth? They are. And that's why I think weaker breadth conditions here are not necessarily a good thing. I had a fantastic interview earlier today. It's not ready for you yet. I've sent it over to my editor with Mike Dixon of Horizon Investments. Mike is a quantitative strategist and money manager. Just a fantastic discussion about benchmarks, about the market outlook, about the process of looking at, of identifying strong stocks and what kind of tools he uses. We also talked about interest rates. Mike was actually pretty constructive on mid caps and small caps, what we call the SMID trade. And one of those bullet points, I kind of pressed him on, what is it that makes you optimistic about small caps here? And he said lower interest rates. And that is fairly accurate. I can't disagree with that. Generally speaking, lower interest rates tend to be better for small companies, right? It's not that lower interest rates are bad necessarily for big companies. It's just smaller companies are borrowing money. Smaller companies that are in a high growth, kind of early emerging growth phase usually need to borrow a lot of money. So lower interest rates means it's cheaper to borrow, which means it's easier for them to grow, ideally. And that should be a great tailwind for small caps. Now, as the 10-year yield has been trending lower since mid-May to now late October, small caps have actually been outperforming a little bit here. It's not happened in the last couple of weeks as the Mag 7 trade has reemerged. But from the end of July to mid-October, small caps have actually been outperforming. And so I think that's something to keep an eye on. Lower rates, and if rates continue lower, which seems to be a reasonable expectation given what the Fed is expected to do on the short end of the curve, not surprising that the longer end of the curve may be coming down as well. And that should be better for small caps. This line at the bottom, by the way, is the relative performance of the Russell 2000 versus the S&P. So sort of small versus large, something to watch. We mentioned the GLD yesterday, closing below the 21-day EMA. We did close toward the highs of the day, but the fact that we're below the 21-day EMA for me tells me initial stop has been broken. That tells me to lighten up a little bit because there's an elevated risk of us going a lot further, right? I was taught all large losses begin as small losses. The way you prevent cataclysmically bad losses and serious capital loss in your portfolio is have a stop and stick to it. My initial stop was the 21-day EMA. I'm unwinding a little bit this week. We'll put some back on if we rally back and continue the uptrend that was accelerating into mid-October. I would not be surprised if gold ends up much further from here before this uptrend is said and done. But I have to respect my initial stop. What you don't want to do, by the way, is set a stop, and then when the stop is broken, just explain it away, right? That is how stops do not work for your benefit. Bad money management is my stop is triggered, I ignore it, and just talk about why it's not that important right now. I'm a big fan of setting the stop and sticking to it. My stop was hit, my initial stop. I'll take some off. Amazon, by the way, one of the many stocks reporting earnings this week. They're on Thursday after the close, I believe. But worth noting, they did make Amazon did break above the early October high, right? The early October swing high is here around 228. We actually got back to that level after bouncing off of the 200-day. I like the fact that we're breaking back above that October peak. Higher highs and higher lows are more bullish. We've been making lower highs and lower lows for a little while. So I think getting back above there, holding the 50-day moving average through earnings, pretty important. Let's see if the RSI can get above 60 as well. If so, Amazon starts to look like a pretty constructive chart. I mean, don't count out sectors like healthcare. United Health Group having a pretty decent stretch here, holding the 21-day EMA. Today was a crazy day on earnings, opened higher, closed lower. So we did not get that follow through the 200-day moving average. That stronger open really drew me in. I started watching the stock to see if we would get a follow through above the 200-day. We did not. After this earnings report, I would want to see a move above the 200-day moving average. For me, that would be the trigger to sort of validate, all right, now there's enough optimism, enough accumulation that I think this could go further. Not quite there yet. Final chart of the day, Visa. Visa's actually reporting after the close today. I mean, why not? Let's take a look and see what's happening. We're recording this after the close, but some of these names may be moving here. Yeah, it's up about 0.5%. I don't know where we're at with the earnings call and investor reaction in the post after our session here, but currently up about 0.5% to 350 or so. So we're kind of trading up here. I mean, not too much above today's intraday high. I think Visa is an important chart. It's not a strong uptrend. It's not a strong downtrend, right? Jesse Livermore famously said, there's time to go long, time to go short, time to go fishing. The way that I translate that as a trend follower is the time to go long for me, right? The time to be taking a long position is when we're in an established uptrend, ideally when we're pulling back and making higher lows. The time to be short or away, leaning away, underweight a stock is when we're in a confirmed downtrend, what I'd call a distribution phase. But that third direction is where you wait. That's where you go fishing. It's where you sit on your hands and you wait for a catalyst. The moving averages, the 21-day, 50-day, and 200-day are literally on top of one another. You can't see them all. Do not adjust your monitor. It's because they're all literally at the exact same level, right below the lows for the last week or so. I would want to see a breakout above 355. That would clear these moving averages, clear the August and October peaks, and make a new 3-month high. I think that would be a very bullish outcome for Visa. On the downside, a break below 335 would undercut those September and October lows. I would see that very negative. Until then, I'm happy patiently waiting, sitting on my hands and waiting for the catalyst to emerge. Don't force it, like I tell my son on the soccer pitch hitting a baseball. Don't force it. Wait for the opportunity. I hope you can keep that in mind with charts like Visa. Folks, that'll do it for today. If this discussion of charts and market movements today on Tuesday, October 28th, elicited any questions in your mind, please use our YouTube channel. Drop a comment there. Don't forget to follow me on the socials. I'm on X at DKellerCMT, always posting some charts and some thoughts there. Appreciate you following me there as well. And I appreciate you tuning in today. For Market Misbehavior, I'm Dave Keller. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.